All right, let's jump right in. Something big is happening, kind of under the radar with some of the world's most powerful financial players. I'm talking about central banks. They're quietly but very quickly buying up a ton of this one particular asset. And it really makes you wonder, right? What do they see coming that maybe we don't? Let's get into it. So, get this. In just 1 month, September 2025, central banks around the globe snapped up 39 tons of gold. Now, to give you some perspective, that's a 79% jump from the month before. I mean, that's not just a little uptick. That's a full-on strategic stampede. This is a huge, deliberate move. And that, of course, brings us to the big question we're tackling today. Why gold? And why are they doing it now? What's the deep-seated fear that's making everyone pivot to, of all things, an ancient metal? Well, we're going to follow the trail and figure it out. Yeah, this is a really big deal. In fact, people are already calling it the 2025 gold rush. We're talking about the most aggressive buying from these major institutions in modern history. It's a sign that they're completely rethinking what money, power, and, what safety even means on a global scale.
But look, to really get what's going on now, we've got to rewind a bit. This whole thing, it's not just about a shiny metal. It's a story that's really about fear. It's about the memory of past disasters and this desperate global search for some kind of stability in a system that, let's be honest, has shown us over and over again just how fragile it can be.
So, if we want to understand the fear that's driving this gold rush, we have to talk about the ghosts of crises past. Seriously. The decisions being made in those high-tech boardrooms today, they are absolutely haunted by the massive financial meltdowns of the last 100 years.
And when you lay it all out, you see this terrifying pattern emerge. You've got the Great Depression, then the 2008 crisis with Lehman Brothers, and then boom, Silicon Valley Bank in 2023. These are not one-off events. These are like earthquakes for the financial system, these huge shocks that just prove how fragile the whole thing is. And believe me, they leave deep scars that the people in charge never ever forget.
And all of that brings us to the single biggest fear in finance, systemic risk. Think of it like a contagion, but for money. One bank fails, and suddenly it's like a domino effect. It can trigger a chain reaction that brings the whole global system crashing down. This is the absolute nightmare scenario. This is what keeps central bankers up at night.
Okay, so here's a look at the two biggest meltdowns. And yeah, the technical triggers were different, right? You had debt deflation back in the 30s, and then these super complex derivatives in 2008. But the root cause? It's exactly the same. It's this tangled web of debt that connects everyone to everyone else. It's what allows a small fire to become this raging global inferno, and it always ends with governments having to step in with these massive, massive bailouts.
So after the absolute chaos of 2008, the rallying cry from pretty much everyone was never again. And that kicked off this really ambitious project to build a kind of financial fortress. The goal was to finally solve that huge problem of banks being too big to fail. Former Fed Chair Ben Bernanke had a great way of putting it. He said first you have to put out the fire, and that was the bailouts. But then you have to go back and rewrite the entire fire code so it doesn't happen again. And that's exactly the thinking that led to the biggest regulatory shakeup since the Great Depression. The idea was to build a system that was, hopefully, crisis-proof. And this was the new fire code, the Dodd-Frank Act. It was this massive, sweeping overhaul meant to make the whole system safer. It set up new watchdogs to look for risks, slapped stricter rules on the big banks, and basically forced them to keep more emergency cash on hand. I mean, on paper, this was the fortress everyone was waiting for. And you knew there was a but coming, right? It wasn't long before some pretty serious cracks started showing up in that fortress. Those new protections? Well, they didn't exactly last. And here's the big one. In 2018, a really key part of Dodd-Frank got rolled back. The rule that said which banks were systemically important, the ones that get the extra scrutiny, was changed. The threshold was jacked up from $50 billion in assets all the way to $250 billion. Just like that, overnight, dozens of pretty big banks were suddenly out of the regulatory spotlight. And this created a really dangerous loophole. It's a phenomenon called regulatory arbitrage. The best way to think about it is like squeezing a balloon, The air doesn't disappear, it just bulges out somewhere else. It's the same in finance. When you put tough rules on one area, the risky activity just flows over to the corners of the market with the weakest rules, where nobody's really watching.
And that loophole? It had absolutely devastating consequences. In March of 2023, Silicon Valley Bank, which, by the way, had assets just under that new $250 billion limit, completely collapsed. It became the biggest U.S. bank failure since 2008. For a lot of people, this was the smoking gun. It was definitive proof that the financial fortress had a massive gaping hole in it. So all of this history, the memory of the crashes, the big attempt to fix things, the rules getting rolled back, and then another huge bank failure, it brings us right back to where we started. It explains everything. It's the reason for this frantic, worldwide search for stability that is driving the 2025 gold rush. Okay, so a huge piece of this puzzle is a strategy called de-dollarization. For as long as most of us can remember, the US dollar has been the king, right? The world's main reserve currency. But that's changing. Countries are now actively trying to depend less on the dollar. They're hunting for assets that can't be frozen or controlled by any one country. What they really want is financial independence. And you can see that shift happening right here in the data. Look at this. Money is clearly flowing away from US dollar assets and searching for other places to go. And who's the biggest winner in this massive global rotation? You guessed it, gold. So again, why gold? Well, it just checks all the boxes for what these banks are looking for right now. It's politically neutral, no one country controls it, it's a classic hedge against inflation and uncertainty, and it's something real, something tangible you can hold in a world that's becoming more and more digital. Put simply, it's the ultimate insurance policy for a world that feels incredibly uncertain. And that brings us to the final big question to think about. This whole gold rush in 2025, it's a huge bet on a very ancient idea of safety. But as we head into a future of digital currencies, of crypto, of totally new financial tech, will a shiny metal that we dig out of the ground still be the ultimate safe place for money? Or are we watching the last great gold rush before the very definition of money changes for good?